Some news just out in the last half hour. ExxonMobil says that it is cutting its 2020 capital expenditures by 30%, says that cash operating expenses will also be cut by about 15% as the company deals with the impact of falling oil prices. Joining us right now on the phone is Exxon's chairman and CEO, Darren Woods. Darren, thank you for joining us today. It's good to talk to you.
Good morning, Becky. Thank you for having me on.
We've been watching the stock price this morning. It's up. Probably on the news that also came out with this is that right now the dividend is safe. Let's talk a little bit about the capital expenditures first, and then we'll dig through some of these things. Capital expenditures down 30% to $23 billion from the $33 billion that had been anticipated earlier. Where are you going to make these cuts?
Well, if you recall, Becky, when last time we met, in fact, I was on your show on March 5th, we had just met with the investment community and talked about the importance of our capital allocation priorities, investing in industry advantage projects, paying a reliable and growing dividend, and maintaining a strong balance sheet. I also mentioned that going into that investor day that we had moderated some of our investment plans in light of the market conditions that we were seeing then, and said that we were going to keep an eye on that and had options to further reduce those. And on the 16th of March, we put out an announcement that said we were going to make some significant cuts, and then today we've provided more detail. A lot of those cuts are coming out of the Permian, where we have a short cycle investment plays there, or more easily adjusted in the short term. And we're doing that while preserving the longer term value. I think it's important to emphasize the work that we're doing there and the reductions are not compromising the advantages that we've built over the last several years of scale, of functional excellence, and then the cube development that we explained, where we're actually maximizing the recovery of the resource and the value. So really the changes that we're making are deferring some of the value. We'll get that back with time as we ramp those investments back up again.
Why is it so much easier to slow down investment in the Permian and still maintain the long-term value for those properties?
Well, a lot of that value is driven by drilling, and bringing on drilling rigs is a much shorter time cycle to bring those on and bring those back off, versus, say, deep water or some of these other larger, much more capital-intensive investments that come on in very large chunks and therefore very difficult to slow down once you start them.
Hey, Darren, your dividend yield as of yesterday's closing price was 8.6%. That's an incredibly high dividend. How do you plan to protect that? How do you continue to be able to say that you feel like that is safe?
Well, we have, over the decades, put a lot of priority on maintaining a strong balance sheet. We recognize, like, this industry has its ups and downs. It's a capital-intensive commodity business, so we know we're going to go through cycles, and the way that we have prepared ourselves to manage through those cycles is to maintain a strong balance sheet, and that continues to be the case today. Of course, over the longer term, to maintain that balance sheet, you've got to have projects and invest in advantage projects. So that is a key priority. And of course, a lot of our shareholders are retail shareholders, people who depend on that dividend. So we've been pretty committed to maintaining that, and if necessary in the short term, using the balance sheet to support it. But primarily that balance sheet is to support the investments in these industry advantage projects. That is the focus, to maintain a very strong foundation for the future.
Just talking about the balance sheet, you were downgraded by S&P to AA stable from AA plus stable. So what do you think about that? How does that impact you, or does it?
Well, the philosophy that we use to manage the balance sheet in our finances has not changed. It's always been there as a tool to leverage in the down cycle, and we're doing that today. If you look at where we're at, our leverage today compared to the broader industry and our peers, still very competitively positioned. And we expect, as we go forward, we'll draw on that and use it. And when the upcycle comes, which it will, we know that the energy is going to continue to grow as populations around the world grow. Certainly been impacted in the short term by the COVID-19, but a recovery is on its way. It's just difficult to tell when it's going to arrive. And so when that comes back, we'll rebuild that capacity. But we've got plenty of capacity, and frankly, that has always underpinned our strategy to make sure that in tough times we have that available to us.
Darren, in the press release that you put out just a little bit ago, you said that you are expecting that the economy is going to rebound, that there's going to be demand there at the other end of this. And you've talked about that bounce back before, that you expect to see a bounce back in consumer demand when these stay-at-home orders are let up and when people can go kind of back to business as usual. When are you modeling? When do you think that's going to happen? Is that a second quarter, a third quarter, fourth quarter?
Well, I'll tell you, Becky, it's really tough to tell. As you know, I know there's been a lot of experts on your shows and others that have tried to anticipate and predict when that's going to come back. You know, we're obviously very aware of broader predictions, and we take a look at that. But I would say we're building a plan that doesn't depend on a particular recovery curve. The idea is to make sure that we get our spending down, we get as efficient as we can so that we can ride through this. And expect then, again, some of these fundamental factors that drive the use of our products, growing economies, people's standards of living improving, those are going to continue to be there and will eventually kick back in, and we need to be ready to meet those demands when that recovery happens.
Joe?
I don't know whether you've seen the president talking about, tomorrow, what's today? I don't even know. It's Tuesday, I think. Anyway, Thursday, I think, is going to be some of this OPEC stuff with Russia and Saudi Arabia. And they keep asking him in these pressers whether the U.S. domestic industry is going to be willing to cut back. And he said already cutting back on production. It's already in the books. And he does, he didn't give an exact answer. Do you think that around the world, 10 to 15 barrels of production, that some type of cut that included even here in the United States, is that possible?
Well, I think, if you look at the challenges the industry is facing now, Joe, it's driven primarily by this drop in demand, the fact that we've lost 20 to 30% of demand here in a very short order. That's a huge transition for the industry to make. And what we're seeing now and over the last month or so is the market responding to that rapid drop in demand. Capacity has to come offline, and there will be economics that drive that and force producers to shut in. There will also be logistics constraints, storage constraints that eventually will, depending on the producer's location, will begin to slow down and potentially force shut-in. So the market will address the shut-in and drive levels down, frankly, because there's no demand for the product, and so eventually you got to stop making it.
Knowing what you know about Russia and Saudi Arabia, do you think that those two countries are in a position to agree on something really substantial in terms of production cutbacks? Or is what we hear about Russia true, that they would like to, to hurt a lot of our producers here in this country by keeping prices low enough to where they're out of business?
Well, it's the OPEC and some of these their positions they've taken over the years have kind of moved up and down. From our perspective, we've always focused very much on the fundamentals and trying to understand what the demand in the world will be over time, and making sure that as a producer, the supply that we bring into the market is low cost and therefore can effectively compete with other low-cost producers like Saudi Arabia and Russia. They are lower-cost producers, and the market would say that in order to effectively compete with them, you need to be lower cost. That's the basis on which we make our decisions and how we choose to invest. Frankly, we've never built in kind of the decision-making of OPEC into how we think about the fundamentals of the business and how we want to invest and position ourselves. We focus much more on the fundamentals of the market.
This idea of knowing you can't see the future, knowing nobody can really predict when this virus is going to be dealt with, when we're going to come up with a vaccine, when we'll be able to go back to life as normal, when we'll have better treatments for dealing with people who do get sick with this. The decisions that you've made today, this 30% cut in CapEx, the 15% cut in cash operating expenses, keeping the dividend safe, those moves can play you out till how long? Let's assume that oil prices stay at $25, $26 a barrel for the next 6 months. Is the cuts that you've made today, does that get you through a scenario like that?
So with the cuts that we've made today, and I may just kind of add to that, frankly, probably the week after I was on your show on March 5th, we started, looking back at the plans and revising it. So the announcement today is a result of about a month's worth of work, very thoughtfully going through our portfolio and carefully making reductions with the intent of maximizing the efficiency of the cuts and working with our partners to capture efficiencies in the marketplace to make sure that we're well positioned to start back up again. We have additional options to further reduce spending if necessary. I think with the uncertainty, we want to keep those options available to us, and as we move through the next month or so, we'll keep a very close eye on the market and continue to adjust if we feel the need to. What we've done to date, I think, allows us to reduce the spend and do it in a very effective way with really any cost of or inefficiencies generated with these reductions being offset by efficiencies we capture from the market. So we feel pretty good about where we're at today, and we'll just have to see how the future unfolds and whether or not we need to make additional reductions in spend. We have those options available to us.
Since you bring it up, those options, do they include the dividend, or you're talking about other options if you have to look at beyond just this?
Well, the way I tend to look at this is for the long term, we got to make sure that we're investing in these advantaged projects. In the short term, we put a pretty high priority on the dividend, and therefore what you've seen to date is a reduction in the capital. I think we can afford to do that in the short term. Obviously, it'll be a function of how long this plays out. And if we find ourselves in something next year, we haven't seen a recovery, that'll be a different environment that we're in. But I think certainly in the short term, we have the capacity to do what we're talking about doing and maintain the priorities that we've talked about, our capital allocation priorities.